All right, fam. So the Federal Reserve FOMC committee cuts rates by 25% basis points. Now, this is no surprise. We've been talking about this on the channel, and whatever it's 89% probability there was for the rate cut to happen. There was a 10% tiny chance that it wasn't, but it wasn't that clear throughout the entire month. And obviously considering the previous FOMC and the lacking economy data and the government shutdown and all that. And it's very interesting, but there is no expectation now for a rate cut coming into 2026 all the way until April. Now, why is that interesting? First FOMC next year is going to be January, then March, then April, and May, Jerome Powell's out. So there's a lot to talk about, a lot to cover. We are going to watch together as JP speaking. Guys, if you are here, we don't really do live shows here. Cuz super happy to see that we have 700 people watching. You're here. Please smash the like. We should do more lives here. This is what we should do more of. So if you're enjoying this, let us know. Let the chat roll. Let this chat just roll. So cuz is not able to see what is actually happening if you're here. And then it's gonna be. I'm gonna run through what we know already. We still have news coming in. So we've got our researchers here on stand, and we still get a lot of news coming in. So bear with us here. Smash the like. Tune in. And if you don't know who I am, my name is 𝗙𝗡𝗙. I bring you these updates. Not these updates, but short updates every single day. So let's get going. Where is the suit? Missed your live shows, 𝗙𝗡𝗙. Thank you. You the man. What happened to Billionaire Channel? It's coming back. We didn't have time. Like your hacker. Thanks a lot. Waiting for Hawkish Powell. It's coming. Hats off to you, legend. Hats off to you. Awesome. Couple live trades. Nice. 𝗙𝗡𝗙. Thanks for the TA. We're... Cuz, do you see this? Cuz, do you see this? Do you see this? Do you see the love? Okay, amazing. Guys, lots of things to cover. Let's get going. So let me just continue. So just going back to this here, right? So someone is saying, is it bullish or bearish? Honestly, so far what we understand, it's basically a nothing burger. Basically a nothing burger. Now we're yet to see what is actually going to happen, but there is some bullish news happening, which I think is super relevant to talk about, and we are going to talk about. One of them is this. So there was an 80% probably 89% probability for a cut. It happened. This is no news. Next year, we're probably not going to have another cut, at least until April. And then it says June 25 basis point. This is all the prediction before this actually happened. But it actually says that we're going to see a 3.25, 3.5 interest rates. But don't forget that by that time, Trump's man is already in place. And the cut is not going to be 25 basis point in June. So this actually sets a very nice precedent to actually have a little bit of a dip in the market and then a recovery as I'm been expecting in 2026. So let's get back here. One of them, even though the 25 basis point cut is basically a no news, the fact that they are buying $40 billion worth of treasury bills, it is a huge news. Why? Because so far when there is quantitative tightening now, Mihir says watching you live now. Legend, much love to you, much love to you. It's DMing me on WhatsApp. Much love to you, Legend. Mihir is the guy who actually took me in Dubai. I'm telling you, he's an Indian guy. He's a cool guy. And then he took me to this Indian place. And he's like, I know a place because I've been living in Dubai. And we literally at 4 a.m. is being wasted. He just kicks in the door. He's like, oh, I'm here. We want some food. Anyway, shout out to me here. Much love, brother. Anyway, so treasury bills on December 12th, they're going to start purchasing treasury bills. And they're going to buy $40 billion worth in 30 days. This basically means that they are expanding their balance sheet. Which basically means that quantitative easing might start sooner than we think. A lot of people confuse quantitative the stop of quantitative tightening with the quantitative easing. But there is something called quantitative neutrality, which basically means that you have nothing happening. There is no expansion, there is no construction, there's just observation. And this is what we should be in, or this is what we're most likely going to go into. But the fact that they are saying, and we're going to see Powell speaking, but the fact that they are saying that they're going to buy $40 billion worth of treasury bills in 30 days, it is a big deal. And there is Michelle comments that says, Michelle, Mike, Fed absolutely keep growing its balance sheet. And here is this tweet just got sent. Contained in today's Fed release, the Federal Reserve announced approximately $40 billion per month of reserve management purchases of short-term treasury security starting in mid-December, with the state goal of maintaining an ample supply of reserves and supporting smooth money market functioning. So that says reserve regime rather than a renewed QE program aimed at easing financial conditions. Anyway, The fact is, we have 1,100 people. We're gonna ratio these guys. So anyway, so we do. I do believe that this is something. It is actually great for the market. We do have some signaling for going into quantitative easing at some point, sooner than later. But, and this is a big but. What? We done it. Amazing. Just keep this going. Guys, smash the like button, please, so we know that you're here. We don't usually do lives, so please just let's going. So this is basically, yeah, this is what I'm saying. So even though that we have this stealth QE, we are going to see an expanding balance sheet, which is great, and money will be injected back to the economy. It's not like a QE we've seen before, quantitative easing, which is, you know, just Powell going money printing all around. But still a new money coming into, liquidity coming into the system. And it is all good and all great, and you will see tomorrow, and even now here, which obviously much respect to these guys, but you can see the 𝗙𝗡𝗙𝗧 saying, you know, breaking news, the Fed cut 50 basis points. This is not breaking news, because we've been expecting this. And this is what I'm saying. Tomorrow you will see every single person saying, this is the next big thing, quantitative easing is starting, and it's great. But this is the groundwork for a market that is not as strong as we like it to be, or that we make out of the news. Every pump in the next 30 to 90 days is there to trap you. You're already asset liquidity. Posted it in October, over a month and a half ago. People laughed at me. They thought I was an idiot for saying this. Every single pump since then, has been there to trap you. You can look at any pump. You can go onto the 4-hour. Every single pump, sell off, pump. Okay, pump, sell off immediately. Here, if you look at, you can look in here. Sell off immediately. Pump, sell off, pump, sell off, pump, sell off. It's not like, if you look here, for example, it's not like pump, a little bit of sell off, pump, a little bit of sell off, pump, a little bit of sell off. It's completely different. It's a downtrending market. And I've called for the end of the bull market, on top of the bull market on October 18th, and I'm, you know, keeping my stance on it. I want you to know that when everybody will tell you too long tomorrow, do not get trapped. We're going to talk about that in a little bit as well. Very important as well, after the last 4 FOMC meetings, Bitcoin dumped, resulting in a 30% dump on the last FOMC. Again, Powell turned hawkish, but it's not only that the market was already, you know, in a very big downward movement. So I wouldn't say that this is because the FOMC, but just bear in mind that we had rate cuts in every single FOMC the last times, and every single FOMC resulted in a sell-off in Bitcoin. Now, usually this is because there is a market maker, smart money, whatever. And if you don't know what my thesis is basically that you need to, the stock market needs to come down, crypto needs to come even more down because the stock market didn't give in yet. One of the major reasons I believe that's happening because 2026 has a lot of catalysts that need to send markets higher. We can look at midterm elections, the big beautiful bill, quantitative easing starting, all stealth quantitative easing starting. We do have rate cuts coming, more rate cuts coming. We do have Jerome Powell leaving the Federal Reserve. We do have midterm elections, a bunch of stuff that tells me that we need to see a very bullish 2026. Now, if that's the truth, the $7 trillion that is sitting on money markets is not going to just get into and top blast the S&P 500. There needs to be a correction. And if that happens, crypto will go even lower. Now, why do I say that? I say that because every single pump that we can see in the market like this is there to get you trapped. If you look at nothing else but the market structure, this is not a longing chart. It's not, okay? And even though that we longed it, and you know, if you're in the community, I've actually obviously share every trade. If you don't know the community, there's a link in the description. You can join in. I share every. What is it? It's pinned. It's pinned. Cost says it's pinned. It's here. Join the fam. So you can just join in the fam. It's completely free. You can join in. But again, like I do share all these trades with you. It's not me figuring it out. I said here is the trade that I'm taking, and then that was the results. So anyway. Even though I'm still in a long position, I sold 75% of my long, by the way. I closed 75. I told you here, realized 7K, and I still have 4K unrealized. But the reason is because this is not bullish. There is a higher time frame rejection here, and then there is elevator down and stairs up. And you never, ever, 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 ever want to be on the stairs. What you also don't want to do is not like the show, because this show is the best show out there covering FOMC. So please smash and obliterate the like button if you like this, and subscribe if you haven't done already. So that said, this was the dot plot last time, which put the median which put the median cut interest rates at 3.75 throughout 2026. You can see it here. This did not change. Now, X was for some reason down, so I can't really bring up the actual dot plot here. But it says the median dot is unchanged for 2026, meaning they still expect 3.75 basis point in 2026. Now, that's the time when it's gonna become quite interesting, because if you look at, where is that? Because if you look at this, that basically says that throughout the entire year, this is the projection, okay? So this is not what is going to happen, not confirmed by the FOMC committee, whatever. Through the entire next year, they're expecting 2 rate cuts happening, going down to 3 basis points, or what is going down to 3%, one in June and one in October. Now, let me tell you one thing, okay? Let me tell you one thing. When Trump's person comes into office, that is not going to happen. There's not gonna be 3% rate. There's not going to be only 2 cuts. We're gonna make it happen. I'm sure there's great people are going to cut it. And I told them to do it, they'll do it. So that is what we're looking into. But is Powell starting now? Is he starting? Let me just go here. I don't want to miss the fact. I don't want to miss him starting. It's still soft porn music. How do you say it? Oh, look at this. Is he starting just now? My timing would be pristine if we would start now. It would be legendary if he just walked in now. Okay, I'll give you 3 seconds. 1, 2, 3. Bow! Okay, let's do it again. 1, 2, 3. Bow! I think not enough people do it in the chat. Can we just say Powell for the 3? 1, 2, 3. Powell! Okay. So let's listen.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus
like I said,
supporting
the reserves
effective
is
control
exhausted.
of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments.
Yeah, and this is not the best, because he's
Although
clearly
some key
defining
government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year.
This is very good.
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures.
Oh, this is very good.
Most measures of longer-term expectations remain consistent with our 2% inflation goal.
This is very good.
The median projection in the SEP
They've
for
never
total
reached 2%.
PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%.
Wait with lungs, wait.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through.
It's going to be interesting to see what is going to happen on the questions.
September, bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027.
I'm calling bullshit now. It's not going to happen.
September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis.
Trump is all I'm saying.
Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets.
Yeah, so he's making sure
we
it's
expect the
only
size of reserve management purchases to decline, though the actual pace will depend on market conditions.
It's very important. He's just making sure it's only about maintaining the increasing the balance sheet, but it's not QE.
In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning, and should be used when economically sensible. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Now, this is going to be crucial.
Howard.
First, turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now
1,500 people watching.
on hold until
You
there's some
fucking
clearer
legends.
signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
Yeah, the market won't like this.
Follow up on the outlook there. It seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now, too. So it's partly that consumer spending has held up. It's been resilient. And it to another degree, I'm going
to look at the market
AI
after this. It's
spending on
very,
data
very
centers
relevant.
and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
That's amazing.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess,
It should. I'm expecting it to
against
come down.
potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of
this AI thing is going to be the biggest bubble?
You don't get a whole lot of decline in unemployment. Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth
or not,
without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time, so it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like? And
subscribe to the channel, fam. Subscribe to the channel.
Where do you think the bigger risk is? And it's very unusual to have persistent tension between the 2 parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed.
You guys are paying attention.
Very thoughtful.
I want one of these for the next FOMC.
And you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and And that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the
we're going to do an analysis afterwards. We're going to talk about it in a second.
We're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
How good question this is.
A rate hike
Are we going to cut again, or are we going to rate hike, as it happened to previous times?
is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the notwithstanding the 150 basis points in cuts prior to today?
Can we get 1,600
The idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times.
A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. Obviously, it wasn't unanimous, but overall, that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So,
cost compliance. I hope you didn't bring up this comment. I didn't say that.
Completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen
growth
anyway.
Revised up, guys. Next year we pump.
April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on.
Will have me forever.
It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman.
We're going to wait a little longer, and then
This
we're
is
going to
the
jump
last
on the charts.
post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. You know, we're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
No, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy?
Oh, the girl in the back. Oh my God, the girl in the back is in love with this
I
guy.
don't think it rises to that
Okay,
level.
I have to put
So
it back. Look.
That as a useful model.
Look at
for
her.
thinking
Look at her.
about,
Look at his eyes.
what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but you know, this is such a unique situation.
paying attention, bro.
It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's
Okay,
the
we're going to
case,
wait one more
that we
question,
try
and then
to,
we're
take
going
a
to jump
balanced
on.
approach
She's a
to
10. I mean, those eyes were like,
look at
what?
how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to. And I think ultimately what it says is
What
when
is
they're
that
broadly
lizard girl?
equally
The
threatened,
fuck is
or
that?
equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That, you know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Because he's going to go mad.
Thanks,
Okay,
Mr.
last
Chairman.
question.
Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, you know, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current
his head
job
is
right now?
kind of like bright.
Or change your thinking?
I give it
at all?
him.
No.
It is.
Like,
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that.
Can't do
And
live streams here,
you've
bro.
got to, when
It's
the
too
long
crazy.
bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the
Is
U.S.
Tom Crown
economy,
also
which
live?
is really unmatched
I'm
if you
gonna
go through the
send
12
this
reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs.
He's not
And
even live.
A
Oh,
lot
he
of
is
that
live.
is not the current
We should
rate of
ratio
high
him.
costs. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling nominal wages are higher than inflation, for people to start feeling good about affordability, the
People's
affordability
wages
issue.
need to keep up with
And,
prices,
so we're
maybe go
working hard
faster
on
Okay, we're gonna go back to
affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're
He's a
sort of
very
trying
good
to
guy,
send
by the
with
way. He's
that,
ghosting me on
that
WhatsApp for
you're
like
okay
forever,
with
but
where
not because he
inflation
hates
is
me,
for
but because
now,
he's just...
as long as people understand that
know.
at some point you still want to get back to 2% because inflation is relatively stable where it is.
Everyone should understand, and the surveys show that they do, that we're committed.
Okay, let's go. Let's cut this. Guys, first of all, if you are here, smash the like button. I love this. I love the fact that we have a chat rolling and everything is, rolling and whatever, and we're here, and 1,500 people live. I think we didn't expect that, did we? 1,500. We thought you're gonna be like 600. I said like 600, 700 something. 700. Yeah, so super happy that you're here. Super happy that the chat is rolling. Super happy that we can make this happen. I think we should make this happen every second week. I think we should have like a big live stream, maybe every month or something. We should do it. So I'm saying you love blondies more than likes. I think my wife is watching, so I'll vote for the likes this time. Prediction up, 93,500 down. Powell makes me sleepy. A long night seems bumpy. It was insane. Pump my F coin. 4 a.m. now here in the Philippines. Nice. She just clicked the mic. Carrying confirmed. We hear 𝗙𝗙. Bull market is over. Cool. I'm giving 10 more minutes. Smash, guys. So what happened? I'm too late to the party. We're just getting started. Live trading with you, 𝗙𝗙. Let's do live trading, 𝗙𝗙. Great idea. 100x happening. Thanks God it's over. Super happy to see you live. I'm happy as well. Vote for the lizard. Is it pumping? Cut Powell. Short the store market. Okay. So let's go. I think we've got a bunch of stuff to talk about. Okay. Very important. One of the most important things is that if you most likely are already subscribed, but if you're not, subscribe to the channel. And in the daily update yesterday, I actually outlined what I think is going to happen. And this is very much what I still believe is going to happen, which is that we need to push into this daily order block. Now, one thing we know, TLDR is here. Downside risks to employment have risen. Inflation in the US remains somewhat elevated. Interest rates are now in a plausible range of neutral. This is new, which basically says, guys, we completed what we wanted to do. Now, F you. GDP growth forecast for 2026 has been revised up, which means they are expecting bigger growth than they expected so far. This, again, just one more thing that adds to the bullish thesis, my bullish thesis for 2026. Reading on inflation are higher. Goods inflation has picked up. It's interesting. Inflation has picked up, but we knew that 3 Fed members decided today's decision, which is not great. The divide at the Fed is growing. So that means that, again, we will need to see how January goes. There is no rate cut expectations for January, okay? We will have a bunch of data coming in from the year and from the previous month as well. It's going to be very interesting to see. So far, what I can tell you is that my thesis did not change with this FOMC, which is I am staying in my long position. I might even consider adding back to my long. I will see what happens in Asia. But again, it's very important. I gave you this trade up here, right? So I gave you this trade up here. This was, when was this? Just see this here. Okay, I can't see it. I can't see it here. Monday. I gave you this trade Monday, okay? And this is this trade basically that I'm still in. We had a little bit of whatever. It went all the way up here, and then I actually said that I'm getting out. I'm selling 50%, and I sold another 25% of this trade. Reason is there is no 4-hour close, and this is still a, so to say, not even so to say, but this here on the total market cap is a clear bearish market structure. You look at the 4-hour chart, we don't even have a strong close above. So I do believe that we need to pump here. The next stop for me is about 3.23 trillion on the total market cap. So about 2%. I mean, I would not be surprised to see this pump and then Asia selling this off. I still would like to see my ideal, if I could just wish for anything for Christmas, what I would say, I would like to have a push here, a pop on possibly, Asia open, and then not even a close above the 4-hour, and then immediate rejection, market structure shift, and then we can short the shit out of this. But I'm not sure that is going to happen. I think the market needs to digest. There is some good news as well. I mean, it is relevant to, for example, the GDP growth for next year has been revised up. Interest rates are at neutral. They got where they wanted to go, so this is not as great. But there is mixed news about the FOMC. The market needs to digest it, and I do think that Asia Open is going to be crucial in a few hours here. I would like to see a push above. We can have a 4-hour close. I actually don't really care. If you look at this, this is a massive liquidity build up here. It's a pool that will be taken. The question is when. If you watch my content, elevator up, stairs down. I mean, this does look like a freaking elevator going down and then stairs going up. So we can come all the way up here, 3.41 trillion. Possibly we can look at around 100,000 Bitcoin, but that won't change my thesis. I currently do not have a TP in. I posted it in the community and I said I do not have a TP. I am going to TP at around 100,000 if I see a rejection. So we're probably going to come up all the way here to the 98,000 region. This is the 50% lag on the daily chart. And once I see that, I am most likely going to take a short position there. I'm going to close my longs. I will update you once that happens. And also very important, I do have my bull market longs open. I literally just opened this power bot. I heard some things. You can do whatever you want to do. I'm just telling you what I'm doing. And then I do have the bull market bots. If you don't know what that is, we're going to put this up. You can see it in the end screen as well. You'll be able to find a description how I bought the dip. But ultimately, this is what I'm actually looking at. And I do think that we're going to pop here, and then we have to reject. It's very important. This might not come back to the 89,000, by the way. This is 5-6%. But on the total market cap, all I'm really looking for is a push above the 3.22 trillion. That is the daily equilibrium, meaning the 50% on the daily leg. This is the daily high. Not even this. There is no 3 consecutive candles here. So don't even consider. You could consider this as a high at 3.59, but I'd rather take it, at 3.72. That's what I would really want to look at and be like, this is the actual level. And so if that breaks, then I can say we are in a reversal. Until then, nothing happens. So every single dip in the next 30 to 90 days is here to liquidate you. So this is what I would be looking at. A pop to the 3.22 trillion, and then an immediate rejection would be the ideal scenario. If that happens, I am going to close my Bitcoin long position as well. I'm gonna jump in here tomorrow in the morning and update you as every time it comes, and that's basically it. Someone says chances of 74K, absolutely in it. I don't think it's happening now, but gradually. I think so. Again, like, I don't know how many of you are new here, but I'm going to tell you very briefly. You have to watch the daily updates, by the way. That's how you will understand. But I do believe that the stock market needs to reject, possibly from around here. I don't think the stock market is going much higher. Maybe into New Year's, whatever, but or maybe into Christmas, but I just don't think it is. And I think we're heading down to the 6,000-ish region. And when that happens, this 15% drop on the S&P is going to be severe on Bitcoin. Even though Bitcoin is down already, I do think that another 15% is absolutely in the cards. We're looking at 75 to 70,000. And also, if you look at the weekly chart, we can go all the way 75, and even on the monthly down at 48, and still be extremely bullish. So we have to see how that goes. How do you base things on total and not Bitcoin? Because total market cap shows me exactly what is happening in the overall market. So stairs up, elevator down is annoying. It is, but you just gotta be on the right side of the trade. Wasn't your two at 95? I don't know what it means. No, as you can see, we do not chase trades yet. Like, guys, this is so obvious. If you look at the community, I even posted, I don't know if I will be able to find it now, but I even posted chilling. I didn't really take any trades, right? And I was just saying, like, chilling, right? I wrote an essay. This is the first time I'm not sitting on trades overnight, and it feels so good. Bang the longs, bang the shorts, and the best 2020 bull market, bots are printing. And this was on Wednesday. And then it took me over 7 days, no, over 5-6 days to take a new trade. But the new trade turned out to be this. I mean, you don't need to trade all the time. The goal is not to trade. The goal is to actually make money. Next 12 hours spike up? I think so. That's what I want to see, and then we'll see how it goes. If we drop below 71K, miners are in trouble. I always hear this argument. Difficulty will just, some miners will turn off, difficulty will ease up, and then it will the cost of mining will go down as well. So I'm not thinking about it. TP was 95K. No. I actually wrote you here. Look. You have to follow. You have to pin the Telegram, and you have to follow along, lady and man and whatever. I said it here. Look, close 50% here. Stop loss at break even. Removed TP, meaning the take profit at 95. We'll see when to take profit. Why power? What is going to happen? I don't know. And it's legit not financial advice. Like, maybe it goes to zero. I was just sitting here in my office, chilling, and then a birdie just came at the window and just knocked like this. And I was like, yeah, who is it? And the birdie was like, me. And I said, what do you want? And the birdie said, long power. And I was like, okay. So I did, and I told you. I don't know. It might go to zero. I have no idea. Are you and red in the same direction? I mean, I don't know which direction is it looking. Is it what? East, north? What are we looking at now? What is it? East, west, side, whatever? I don't know.
Pull up the compass.
I'm not pulling up a compass, bro. What? Do you have like a physical compass here? No, you're digital. So what is it? West. Northwest. I'm northwest. Ask Ren what direction he's looking at. I'm short ETH. Is it worth to go long now? See you tomorrow. Thank you. Much love. Market is pumping. Soul is ripping. Soul is ripping. Let me just look at the rip of the soul. Guys, every time when the market is ripping like this, that's the time you sell. 141 on soul. That's actually decent. My buddy John had a great trade. It's 3% up, but it's still decent. It's still decent. We're close at 94K. Should we enter long again? But bro, like, I'm telling you step by step what I'm doing. You're doing something else and you come here and you ask me. Like, I love you. I genuinely do, but I can't. It's like, imagine me saying, don't jump in front of the bus because it will hit you and will break your legs. And you jump and you're like, how can I run again? Like, I don't know. Bro, I told you not to jump in front of the fucking bus. Will we get... Of course you get that, bro. Of course you do. Let me just go. How do I, what's the song?
Crazy Frog.
So I'm saying, how would you create a trading course for me? It's coming, guys. It's coming.
They're prompting you.
Prompting. On those ripping. Jump again. Long the top. Yeah, good luck. Go long the top, monkey. Guys. So these are all Ledger stacks coming from Ledger. We are going to give it away. I'm doing a Christmas live stream. You know this. It's going to be a hell of a stream. If you are not going to attend, I don't know what to tell you. I mean, if you're not going to attend, I wanted to say the G word, but I don't want to say that because it's not good. But like, you know, you have to attend. It's going to be awesome. And all of these are, drum roll, 100x Club branded. So these are Ledger stacks, and there's a 100x Club logo on the back. It's gonna be legendary. I want the Solana one. I do have the Solana one coming as well, and I will have Bitcoin one coming as well. Hold on a second. Is this guy tripping? Just got $670 on 𝗪𝗢𝗡𝗙. Do you see the fucking future, bruv? Where is 𝗪𝗢𝗡𝗙? If 𝗪𝗢𝗡𝗙's at 670, I don't know what I'm gonna do. 205, what are you talking about? You tripping? Too much wheat for you. Don't do it. Every time you dance, it bumps.
But YouTube, you don't use those substances?
Don't use substances. It was just a joke. Not financial advice. Woo! What did I push? Okay, someone is saying, OMG, 𝗙𝗙𝗙, we have to go. Guys, appreciate you a lot. Thanks for being here. Again, a pop to the 3.22 trill. That's what I'm looking for, and then a rejection there. Guys, check this out. Thanks for tuning in. Coming for the next one. Tomorrow, we're going to have the daily update, and we're going to do more of these live streams. Take care.